You know the name Warren Buffett, right? The billionaire, the legend. But here's the thing. Today we're not talking about that guy, the one who buys giant corporations. Nope. We're going to jump in the time machine and break down how a young, really scrappy kid from Omaha became a millionaire at just 31 years old. And let me tell you, his early playbook is probably nothing like you imagine.
You see it all the time, right? People track Buffett's latest moves. They see what Berkshire Hathaway is buying, and they think, hey, I should do that too. I mean, it makes sense. If you want to be the best, you copy the best. But when it comes to Warren Buffett, that might be a massive mistake.
Because here's the reality check. The game Buffett is playing today, with hundreds of billions of dollars, is a totally different sport than the one you or I are playing as individual investors. So if you really want to learn from the master, you need to stop studying the behemoth he is today and start studying the young grinder he used to be.
So let's do just that. Let's zero in on that version of Buffett, the one whose story actually gives us real, actionable lessons for anyone trying to build wealth today.
I mean, just think about this for a second. As a young guy, Buffett could be nimble. He could hunt for these tiny, totally forgotten companies where almost nobody was looking. And that's where he found explosive returns. Today, with all those billions, he has to buy giant companies like Apple or Coca-Cola, which means his growth is naturally going to be slower. That's an advantage you, the small investor, actually have over him. Crazy, right?
And if you don't believe me, well, the numbers don't lie. Just look at the difference in percentage growth, the kinds of returns young Buffett was getting. I mean, it was an absolute landslide compared to what's even possible for him today. It's a completely different universe.
So you've got to wonder, how did he even get his hands on that first chunk of change to invest? It wasn't some stroke of investing genius, not at all. It was pure, old-fashioned, roll-up-your-sleeves hustle. And it started when he was just a little kid.
Can you believe it? At just 6 years old, this kid is going door to door selling chewing gum for a 2-cent profit. But those little profits, they added up. By the time he was 14, he had saved $1,000 just from his paper route. And get this, by 16, he was pulling in $175 a month, which was more than a lot of adults were making back then. This wasn't about luck. It was about a relentless work ethic.
So where did this incredible drive come from? Well, a lot of it was sparked by a book he stumbled upon at the library. The title was literally 1,000 Ways to Make $1,000. And the message inside was simple, but it hit him like a lightning bolt. You have to start. Not tomorrow, not next week, today. And boy, did he take that to heart.
So at age 11, he takes some of his savings and makes his very first investment. He buys some shares, convinces his sister to jump in with him, and then watches the stock immediately drop. And you know what he did? He panicked. He sold the second he could get out with a tiny $5 profit. Of course, right after he sold, the stock soared. It went up to a point where he would have made nearly $500. And that one painful mistake taught him 2 lessons that would literally shape his entire future. Don't get obsessed with what you paid for a stock, and have the patience to let a good thing run.
Okay, so hustle is great. Early lessons learned the hard way are crucial. But that's not enough, right? You need a strategy, a real philosophy. And young Warren was about to discover the one that would change his life forever.
So fast forward a bit. He's 19 years old and has managed to save an incredible $9,000. But all that money came from his little businesses, from hard work. When it came to the stock market, he was still just guessing. He was trying everything, reading charts, technical analysis, but nothing really clicked. He didn't have a system.
And then he found the book, Benjamin Graham's The Intelligent Investor. And the first big idea that just blew his mind was this concept of intrinsic value. It's the idea that a stock isn't just a squiggly line on a chart. It's a tiny piece of an actual business. And that business has a real, calculable worth that's totally separate from its day-to-day stock price. Okay, this next idea is brilliant. Graham tells you to imagine the market is this moody, manic-depressive business partner named Mr. Market. Some days he's terrified and offers to sell you his share of the business for pennies on the dollar. Other days he's euphoric and wants to buy your share for an insane price. The key? You don't listen to his moods. You just use them to your advantage.
And this last one, this is the one that brings it all home. The margin of safety. This became Buffett's golden rule. It's just the simple, powerful discipline of only buying a business when it's on sale, when its price is way, way below its actual value. That discount is your buffer. It's your protection in case you get something wrong.
So now he had the tools. He had the philosophy. He wasn't just a hustler anymore. He was an investor with a logical, repeatable plan. And he started putting it to work with a strategy Graham famously called the cigar butt approach.
Now, the name is kinda gross, but the idea is pure genius. Imagine you're walking down the street and you see a soggy, discarded cigar butt. It's ugly, nobody wants it. But what if there's still one good puff left in it? If you can pick it up for free, that one last puff is pure profit. That's what Buffett started doing with stocks.
And he found these deals everywhere. Take a company called Sanborn Map. He could buy shares for $45. But when he looked at their books, he saw that the company itself owned $65 per share of other stocks. Think about that. You're literally buying a dollar bill for 70 cents. Who wouldn't take that deal? Or Dempster Mill, selling for $28 a share when its assets were actually worth $75. Back then, if you were willing to do the digging, these opportunities were just sitting there, hiding in plain sight.
So, the big question, did all this actually work? Oh, you have no idea. Between 1957 and 1961, he started these little investment partnerships for his friends and family, and he absolutely destroyed the market. Even after he took his cut, his partners more than doubled their money. The overall market, it was up just over 42%. It wasn't even close.
So all this grinding, all this learning, all this disciplined investing, it was all building towards one massive moment, the culmination of his entire young life's work. In January of 1962, when he rolled all his partnerships together, Warren Buffett took a look at his personal stake. The number was $1,025,000. At 31 years old, the kid who sold gum door to door was officially a millionaire.
So let's break it down. What's the actual blueprint we can take away from this? First, the grind. You got to start early and build your capital through sheer work. Second, you have to be a learning machine, devour information to find your edge. Third, you need a core philosophy, a rational way to operate. Fourth, you have to execute that philosophy with discipline and patience. And finally, you can use leverage, like partnerships, to scale up your success.
When you really boil it down, young Buffett's superpower was his ability to find incredible value in these small, obscure corners of the market that everyone else was completely ignoring. Now, the world is different today, for sure, but that basic principle hasn't changed. So it leaves us with a really important question. In this sea of information we all live in, where is your edge hiding?